Well, first of all, are you on the same page, I guess, with Gus when it comes to that economic outlook? And then talk to me about how the Fed plays into this. Right now, if you look at Fed funds futures, they're pricing in about a 25% chance or so that we could get another interest rate increase. If indeed we're headed to recession, what are the implications of that?
Yeah, we think the Fed is actually done for this monetary tightening policy cycle. We think their next move will actually be, not to raise rates again, but actually to start cutting rates as soon as possibly early next year. So in our view, we're looking at very strong GDP here in the third quarter. I think our current view is about 3.9%. We are looking for GDP to start softening over the next couple of quarters. So in the fourth quarter, we're only looking for about a 2% GDP rate. And for beginning of next year, a little bit under 1% in first quarter, and then getting pretty close to stall speed, but still above, negative in the second quarter. And then looking for the economy to start, recovering thereafter. Now, we also do think that inflation will continue to keep moderating. So we think that a combination of the slowing economy with inflation moderating will actually give the Fed the room that it needs to actually start cutting rates next year.
And Gus, I'm interested to get your response there. You agree with that call? You think the Fed is done with this rate hiking campaign? You expect them to pause in November? And when do you, just as importantly, Gus, when do you think they can actually start cutting and by how much?
Well, I do think that they're done. I think we are seeing inflation move to the 2% objective. We have seen the labor market cool off significantly, and I think the unemployment rate will move higher through the rest of 2023 and into 2024. That being said, I foresee rate cuts sometime probably in the second quarter of 2024, but that's because the economy is going to be in recession, we think. That will cause inflation to slow more dramatically. We'll move from job gains to job losses. We'll see the unemployment rate rise more quickly. And that means that the Fed will start to cut rates sometime in the spring of next year in order to combat a recession.
Gus, I want to zero in on the economic data that we got today for just a second, because we got a measure of factory activity or manufacturing that did contract, but it didn't contract by as much as estimated, and it contracted by the least, in nearly a year's time. Are we seeing an inflection point for manufacturing at least?
I don't think so. I mean, interest rates are still very, very high. Tighter monetary policy works on the economy with a lag. I think that right now the Fed funds rate is contractionary. It's weighing on economic activity. So I do expect that we'll see some more softness in manufacturing. And then don't forget, we've seen mortgage rates move significantly higher over the past month or so. So housing related manufacturing is going to slow through the rest of this year and then into 2024 as well.